Now, analysts project that the central banks in Africa's biggest economies are set to maintain tight monetary policies to contend with persistent inflation. Egypt, South Africa, Morocco, Kenya, and Ghana are poised to keep their key interest rates at current levels while they assess risks to inflation from domestic and global factors, including geopolitical tensions in the Middle East. However, Nigeria's rate decision looks like a toss-up between a hike and a hold. This morning, joining us to unpack this is Professor Andrew Roux, an economist at Stellenbosch Business School, Stellenbosch University. Thank you so much, Professor Andrew Roux, for joining us on the show.
Thank you, and good afternoon to you and all your viewers.
Of course. Now, let us start with the factors fueling inflation in many African countries. What are they, and what do you make of how the various central banks have been handling them?
Yes, well, I think maybe let's just go back a few months and remind ourselves that not too long ago, across the entire planet, inflation rates were rising at a speed not seen for many, many years, including, of course, the so-called developed countries. And so we saw across the world interest rates moving upwards and moving up quite dramatically. And this is all fueled by a number of things, ranging from obviously pent-up demand. I think post-COVID-19 pent-up demand started coming through. Add to that the fact that many countries had adopted a very, let's say, relaxed monetary policy. That started coming through. And this is all accelerated by a couple of years ago, the problems in Russia and Ukraine, obviously influencing the oil price. So 4 years ago, the oil price was $10 a barrel. 2 years later, 2022, $135 a barrel, now down to $80 or $90, but still nearly 9 times higher than 4 years ago. Then, of course, food prices started accelerating, again, partly due to the crisis in Russia and Ukraine. Supply chain problems started exerting an influence. And all of this resulted in, as I say, a rapid increase in inflation across the world, and along with that, rising interest rates. The good news is that in most countries, certainly internationally, inflation rates are coming down again, and interest rates have been put on hold, as you quite rightly point out in the introduction, again, across the planet with 1 or 2 exceptions. So the question now arising there, and I think here in Africa as well, is not so much whether interest rates are going to come down, but rather when they're going to come down. And I do believe that central banks are taking a very conservative stance here in Africa as well. And I think rightly so, by saying, well, let's not be too hasty. Let's not lower interest rates too quickly. We think the time is getting riper and riper for that to happen. But let's just check things out a little bit further. If there were to be some kind of unexpected inflationary shock, we don't want to be caught sort of with our pants down. So let's keep things steady for now and start gearing up towards a decrease later on in the year. So what are those things that they are wary of? As you pointed out, the Middle East crisis, always problematic geopolitical tensions. One hears stories that shipping lines are not using the Suez Canal so much, but rather taking a longer route. That obviously adds to the cost of transport. And depending on countries, there might be idiosyncratic issues. Here in South Africa, for instance, there's a bit of a concern that inflation has edged a bit upwards in the last couple of months. Still lower than what we wanted, lower than the upper range of the target, but it hasn't come down considerably. We add to that things such as continued supply chain constraints. Obviously, depending on the country, there might be drought-related food shortages. There might be still concern about another increase in the oil price. Here in South Africa, wage increases might be higher than the inflation rate, which will create more inflation. So it depends on the country, but overall, I would say that central banks are erring on the side of being conservative, which is not necessarily a bad thing, although obviously it is painful for many people to try to deal with high interest rates.
You mentioned that there are some instances in some countries where interest rates, where inflationary pressure have reduced. But then there are some countries that, whatever the case may be, we still see the rates hike going up unabated. For example, we look at Nigeria, where some economists and business owners have said that the monetary tightening stance of the CBN is ineffective And as a hike, we see that in MPC seems to equal more inflation. So what do you make of this? Or is this just a peculiar situation to Nigeria?
No, look, it's always been a dilemma for central banks because obviously when central banks use interest rates as a tool against inflation, they're actually addressing monetary factors. They're trying to slow down the growth in the money supply via slow down the growth in demand for credit. And that is what it is. But obviously, many of the factors contributing towards inflation have nothing to do with the money supply. I've mentioned a few, such as an increase in international oil price, an increase in international shipping prices, an increase in food prices, have nothing to do with monetary aggregates. And that's the dilemma that central banks always face. They only have one or two tools, one tool really, namely manipulating the money supply, and they cannot influence Nigeria, South Africa. No one can influence the international price of oil. They can't influence the international price of food. They can't influence droughts. So they always have to kind of take on the onus, the burden of trying to reduce inflation, although knowing full well that some of the factors are beyond their control and are dependent on many other external factors.
Okay,
One
now,
does, sorry, can I just say, one does find, however,
okay, okay.
that after a while, and there's always a time lag involved, but you generally find that an increase in interest rates will, after a lag of 9 to 12 or even 15 months, eventually result in a slowdown in inflation.
All right. So while we're actually seeing a change in other emerging markets like Latin America and Europe, we see that Africa's biggest economies seem to be holding on to policy tightening. And earlier on, you mentioned a cross-section of factors that actually influence what the NPC decision will be. Now, are there differences as to the reactions that we see in other continents as different from what we see in Africa? And that fuels what kind of decision the NPC would eventually have to take?
Probably yes. I mean, I just mentioned the time lag involved. So in some countries, I don't want to mention names, but let's say the developed world, a very small increase in interest rates will bring about a fairly quick reaction from consumers and borrowers in terms of slowing down their demand for credit. In other countries, and I can speak about South Africa, for instance, it takes quite a significant increase in interest rates before consumers will ultimately start slowing down their demand for credit. There's a much longer time lag involved. But having said that, using interest rates is what we often call a very blunt instrument. It's difficult to fine tune it. And we also have to think about the reality in many African countries of households struggling to survive, struggling to keep their heads above water, with incomes perhaps falling in real terms. They have to take refuge. They have no choice but to borrow money just to survive. And that's a very sad reality. It is a reality, but a sad reality. And you therefore find that very often in an African context, even with fairly high interest rates by international standards, the demand for credit carries on growing at quite a speed. So that means that central banks have to further raise interest rates to bring about the desired effect.
Okay, so let's now tie this to Nigeria's legal tender. Well, some analysts suggest that the CBN would hold rates due to a steadier naira. So do you believe that the current stability justifies pausing rate hikes, or do you prefer a further rate hike in a bid to address these inflationary pressures?
Yeah, look, I cannot confess to intimate knowledge of the situation in Nigeria, but if I can just try to answer the question generally, one must also bear in mind there is a very close link between interest rates and the value of a country's currency. So, putting it very simplistically, if interest rates drop in a country, let's say Nigeria, but elsewhere in the world interest rates are not dropping, there's a good chance the local currency will weaken because investors might withdraw their investment, seeking higher returns elsewhere, and that would result in an outflow of dollars or other foreign exchange from the country, and the country's own currency will weaken. So, put differently, if you want to try to stabilize a currency, it's not very wise to lower interest rates. Again, there's always a threshold. You're never quite sure beforehand what kind of increase in interest rates are required to stabilize the currency. Because bear in mind, a currency's value is influenced by a whole host of factors, not just interest rates. But certainly, typically central banks are tasked with maintaining the internal and external stability of prices. So if inflation is rising, if a currency is coming under pressure, then it does make sense to adopt a fairly restrictive monetary policy.
Mm.
And also bear something else in mind that, and this is the essence of economics, if your currency weakens, that actually creates even more inflation because you're going to import goods at a higher price. So you're importing inflation, and that just reinforces that vicious cycle. So I'm afraid it's throughout the world, but perhaps in Africa more so than others, there's a very real trade-off between high interest rates to combat inflation versus lower interest rates to try to stimulate growth. You can't do both at the same time. You can't get low inflation and high growth necessarily with one single monetary policy instrument. So
Mm.
if you want to lower interest rates to try to stimulate economic growth, chances are you're going to get more inflation and a weaker currency. If you want to combat inflation by raising interest rates, you might suppress economic growth. That's the
Okay.
reality of economics and so-called trade-offs.
Okay, understandable, I must say. Professor Roux, let's leave Nigeria and quickly look at the Horn of Africa nation, that's Kenya. Now, we see that the currency has also gone from being one of the worst performing currencies in the world to the best in less than 3 months. And also, inflation risks have diminished due to the deceleration of the primary drivers when we talk about food and fuel prices, which are very essential to every citizen in Kenya. How would you say that the Kenyan government was able to achieve these positivity?
Well, I think it's essentially by deliberately adopting, let's call it conservative policies, and especially conservative monetary policies, by sticking to their guns, despite the pain involved of maintaining and retaining a strict monetary policy, is now starting to pay dividends. And that's another perhaps general message that a monetary policy, let's say a strict monetary policy, doesn't yield overnight success. You've got to stick to your guns. You've got to resist the temptation when the going gets tough to relax interest rates, only to discover that a year later you have to raise them even more dramatically than would otherwise been the case. Which brings me back to our current story right now. And my introductory statement, I think that central banks in Africa are playing a conservative game, rather keep rates where they are and not lower them yet. It might be too premature. Let's wait a bit longer. You don't want a situation where you lower interest rates now, only to discover in a year's time you were too hasty and now you have to really considerably raise those interest rates. And I think in many ways, Kenya has followed such a conservative, careful approach.
Okay, so we now also look at the dynamics of monetary policy tools such as rate hikes or cash reserve ratio. Now, while an interest rate hike is expected to be positive for investors as it translates, of course, to real returns on their investments, especially when it is either higher or close to the inflation rate, we are also aware of the trade-off in output or production, as the case may be. So is there a way whereby we can balance this?
Sorry, just repeat the last. I just missed the last part of your story. Sorry.
So I actually asked if there's a way that we can achieve an equilibrium when we look at the issue around rate hikes and the cash reserve ratio as it relates to investors, what they get, and the trade-off trade-off in output of production.
Yeah. Again, it's kind of back to what I was saying, but there's always, as you say, there's a trade-off. The typical conservative, let's say, central bank view, it will always be our main aim in life is to control inflation, but there's a reason behind that, because in so doing, it creates a space, it creates a more stable environment, a more attractive environment for future economic growth. And that more attractive environment would hopefully, amongst others, as you are saying, help to attract foreign investment, which, as we know, is much needed in Africa. The savings ratio, the savings rate in Africa is too low to finance investment from domestic sources. We need more foreign investment. We can't dispute that. And investors look at a whole range of factors, economic factors, monetary factors, but also what I call perception factors, risk profiles, risk analysis. And one of the things that favor a country, a recipient country, is having a stable macroeconomic environment, which includes, as we keep on saying, inflation being under control, a currency which doesn't fluctuate too rapidly. It includes having fiscal discipline. In other words, where you don't see the budget deficit ballooning and you don't see government debt becoming uncontrollable. All of these things help contribute towards, in the long term, an attraction of investment, both local and international, and eventually then pave the way for economic growth.
Okay. Professor Andrew Roux, economist, Stellenbosch Business School from Stellenbosch University. Thank you so much for talking to us. It was nice having this time with you.
Thank you very much.